Back in August 2023, I did a review of a business development company called Blackstone Secured Lending Fund, BXSL. It's paying a yield of just over 10%, and over the past year, the price is up 14% for a total return of 28%. It begs the question, if that business development company is so good, what about other business development companies? Well, there are about 50, so do you really want to research all of them? If the answer is no, I know I don't, you can just buy PBDC. Almost 10% of that fund is BXSL. The fund manager, Michael, specializes in BDCs, and the fund currently holds his 21 favorites. Today, I'll show you funds from 5 high-income sectors that hold a total of 533 securities and pay an average yield of 8.6%. I'll also tell you which ones I own and why. If you've ever purchased a BDC or any of these other income investment categories, you've probably wondered, isn't there a fund that specializes in this? That's the question we'll address today. Since inception in 2022, PBDC has delivered a higher total return than the S&P 500. That's impressive considering that this fund is yielding almost 10% and consists entirely of business development companies, not tech companies. BDCs are private lenders, so they have a lot more flexibility than banks. For example, if they think a loan will help their borrower grow its stock value, they can invest in that stock and eventually profit from the loan interest as well as the sale of the stock. If you don't want to research individual BDCs, the most popular way to buy with just one click is BIZD, B-I-Z-D. It's an ETF that simply follows the MVIS US Business Development Companies Index. I chose PBDC over BIZD because it's actively managed. The portfolio manager, Michael, can trade BDCs based on which ones are over or undervalued relative to their net asset value. He can also follow default rates and other key indicators. If you want a large, well-established fund with a long history, BIZD gives you exposure to the major BDC players. But if you want an active manager, PBDC has been outperforming since its 2022 inception. I bought PBDC in 2023 and I plan to hold it for the long term. I also hold some individual BDCs, but recently I've been weighing more towards PBDC for the diversification. If you'd like to know more about PBDC, I featured it in this episode and I'll link it in the description. By the way, if you're new to the channel, I retired in 2017 and that's when I got serious about researching my investments in greater depth because, well, now they pay for everything. I mostly focus on stocks and funds paying consistent yields of around 8% or maybe a smidgen more than that. Next is the category you're probably most familiar with, and that's REITs. RQI is yielding just over 8% and has a history of paying mostly consistent dividends that goes all the way back 20 years. The shift from quarterly to monthly distributions is a bit confusing on this chart. It looks like a cut, but it wasn't. Just a change from 24 cents quarterly to 8 cents monthly, which is the same thing. The challenging time for this fund, as with many funds, was the 2008 global financial crisis. In 2008, the total distributions came to $1.80 for the year. In 2009, they were cut back to 41 cents for the whole year, which is catastrophic. Since 2015, the distributions have been 96 cents per month, so they never recovered to the pre-global financial crisis level. The fund held 203 securities as of the end of 2023, but the top 10 account for half the portfolio value, so you'd need to be okay with those 10 to invest in this fund. I like most of those names, especially Prologis. The other thing to be aware of is that this is a closed-end fund, and that means that the price of the fund doesn't precisely track the value of its assets. It's currently priced roughly 6% below its net asset value. In other words, the price is relatively low at the moment because REITs are out of favor. They use a lot of debt, which is currently expensive because of high interest rates. That's further exaggerated because this closed-end fund juices its yield with 30% leverage. That's how they can pay a higher dividend than the individual REITs within the portfolio. Whether to invest in a fund like this depends on your outlook for interest rates and real estate. If you believe rate cuts are coming soon, this is the way to benefit from that. Interesting to look at total returns for RQI. It's currently lagging the S&P 500, but over the past 10 years, it has frequently outperformed the S&P 500. It's just a matter of timing. I'm currently interested, but not committed to this one. Yes, I want to have some REIT exposure when interest rates fall, but I don't think it's necessary to be early on this one. Blackstone has been buying up REITs recently, which is interesting, and this article from Seeking Alpha covers that and a few other reasons to buy RQI at the moment, including the discount to net asset value I mentioned earlier. Personally, I don't buy a stock or a fund without first checking it on Seeking Alpha. I'm on there pretty much every day. I'll link to the article I just mentioned and a discount for membership in the description. PFFA is currently yielding just under 10%. It's been paying a mostly consistent dividend since 2018. There was a cut during the COVID crash, but it wasn't disastrous. It was 19 cents down to 15 cents, where it's remained ever since. Preferred stocks are like a hybrid of common stocks and bonds. The word preferred refers to being in a preferred position over common stockholders. If there's a dividend cut, it's the common stock that's cut first, and the preferred stock dividends are the last to be cut. Common stock dividends are typically announced each quarter, and they can change based on the decisions of the board of directors. In contrast, preferred stock dividends are set on day one when they're issued. They usually begin as a fixed percentage of $25. Researching preferred stocks is complicated. Their values are affected by factors like whether they switch from fixed to floating rates and the timing of that change. PFFA gets you diversified exposure without all the effort. It's worth noting that it's leveraged by 20 to 30%, which contributes to the high yield, but also increases risk. Preferred pricing moves in the opposite direction to interest rates. As interest rates rose recently, preferred prices fell. So this is another bet on interest rate cuts. However, a yield of just under 10% is a pretty decent payout while you wait. I purchased PFFA in 2023 and I plan to hold it for the foreseeable future. If you'd like to know more about preferred stocks, this episode is a deeper dive and it's linked in the description. MLPA is currently yielding just over 7% and gives you exposure to midstream companies that transport, store and process oil and gas. I entered this sector when I bought Hess Midstream, ticker HESM, which currently offers a similar yield. HESM has a history of paying consistent distributions since 2017. Even better than that, it has consistently raised distributions like a champion. This distribution chart came from a dividend tracker called Snowball, and you can get a similar one from other websites like the one I mentioned before, Seeking Alpha. Mostly, though, I use Snowball for info specific to my portfolio, like keeping track of income. In a recent review, I mentioned that the iPhone app was coming, and last week it was released. So if I want to know when my next dividends arrive, I can just scroll through and see dollars coming in by day, and I can click those for more details. I'll put a link in the description for a free trial and a discount. A few times a year, Snowball runs promotions. Actually, if you're watching this before March 14th, 2023, there's one on right now. Anyway, the link will connect you to the armchair discount or the promotion discount, whichever is the greater of the two. Back to HESM. My first thought after researching HESM was, how can I buy more midstream companies like this one? There's also the minor issue of K1 tax forms. HESM doesn't issue a K1, but most MLPs do, and many investors don't want to collect those forms from individual MLPs, which makes sense. Buying an MLP fund, though, can eliminate that hassle. Looking at the distribution history for MLPA, the slope is pointing, well, the wrong way. I also looked at its competitor, AMLP, which holds a similar portfolio and also dividend cuts. If you want to study the midstream sector and learn what drives their revenue cycles, perhaps you can get comfortable with that distribution history and explain how it's going to change in the future. I don't really want to do that, so I'll stick with HESM for now. Also, my accountant said he's okay with filing K1 forms, so I'm going to look into some MLPs like MLPX and EPD later this year. The last category for today is closed-end funds. This isn't a business sector per se, it's an asset class. Closed-end funds can hold investments from just about any business sector. The reason I'd consider a fund of CEFs is that they can trade above or below their NAV, like I mentioned earlier. If a fund manager can buy when the discount to NAV is deep and then sell when the premium is high, perhaps they could generate higher returns than an amateur like me could. Or at a much simpler level, I currently own a CEF called UTG. Is there a fund that buys other good CEFs? Well, systematic income investing tracks 12 funds that hold closed-end funds. It's a bit confusing, but these are funds of funds. They pay out most of their returns as income, which is fine, so their NAV doesn't really grow that much. However, the one that grew the most of that group was an ETF with the ticker CEFs. It's yielding just over 8%, and the distributions have been fairly consistent since its 2017 inception. If this fund performed well over the long term, but was temporarily in a lull because of high interest rates, I'd be up for it. But if we look at total returns over the life of the fund, there's really no period worth bragging about. Another factor to consider is that as a fund of funds, you're paying a lot of fees. Each of the 100 or so funds in CEFs charge a management fee, which averages out to 1.32%. Then the fund manager, SABA, charges their management fee, which is 1.1%. You could make a case for CEFs being the best fund consisting of closed-end funds. I'm just not a fan of these funds of funds, so I'll stick to picking closed-end funds individually. So I have two of the five, PBDC and PFFA, because I like those sectors, I like the diversification, and I think the portfolio managers can do a better job than I can. So now I'm curious to hear your thoughts. If you've invested in a fund that does a good job of covering a high yield sector, feel free to share it in the comments and we can discuss. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, I made a playlist to save you time. That wraps it up for this look at funds targeting specific high income sectors. More armchair income coming soon.